Okay, folks, welcome. This is Patrick Zielbauer from Infinity Futures. It's 3:30 on Monday, December 17th. Thanks everybody for coming today. Let's go ahead and read the risk disclaimer, answer any risk-related questions, and then we'll get right into it. All right, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations can change at any time. Past performance is not indicative of future results. So, firstly, I want to say thanks to everybody for attending these events. This is going to be the last event that we are doing this year. Okay, so next 2 Mondays, I will not be presenting. Our format is going to change next year. I'm not going to spill the beans quite yet on what it's going to be like, but it's going to allow us, I hope, to be much more responsive to the types of questions we've been getting. And I hope to put out, somewhere in the neighborhood of 2 to 3 times the amount of content I'm doing on a weekly basis through these events, through this other format. So we're still going to be doing live events. The format's going to be different, and the accessibility to some of the new content's going to be a little bit different. But we have some really good ideas, and we've been getting a lot of feedback from people this year. But I do want to say thank you for coming to the presentations. There's a lot of people here who have come, for every Monday now for a couple of years, and it's really very much appreciated. All right. Okay, so my name is Patrick Zielbauer, and I'm an AP or associated person of Infinity Futures. Been here for about 14 years, okay, going on. And we've been doing these presentations for a while on Sierra. Sierra is a charting program that we offer and support here at Infinity. And if you do 10 round turns every 30 days, then we waive our fee for Sierra, which if you're not familiar yet, it's $19.95 every 30 days. Again, if you buy and sell one contract 10 times, let's say in that 30-day period, then we waive the fee. So this is a little bit cheaper than if you were to even go to Sierra directly to buy it or lease it, or pay with your credit card or something. So we can offer it less expensive. We also provide what we believe to be the best support for Sierra Chart. We are very in-depth in the program. Our support's excellent, and we're always challenging ourselves and our clients with trying to learn more aspects of Sierra, because it really is a phenomenal program. All right. Okay, so let's get into it. Now, before we start going through the charting, I do want to mention briefly this element of the blurb, the promo for the presentation, which was, that we're incorporating elements of profile, price action, intermarket analysis, volatility. What I'm going to do today is show this chart file that I have compiled over the course of the year that touches on a lot of these things. One of the things that I am uniquely positioned for, given my place in the business, is that I listen to all my customers, and I hear the questions. I also see the trading activity. I see the good stuff. I see the bad stuff. I see the success. I see the failure. I see the difference between simulated and live trading. I see people try to incorporate very complex methods or ideas that work great in a simulator that they can't make work in the live environment, even though the ideas might be very valid. So I just want everybody to know, especially the people who are maybe less familiar with Infinity or less familiar with me, is that every aspect of what I'm trying to do with the charting is to simplify things to the point where I believe that my clients can use it while they have something that they value at risk, like money. All right, one of the big differences between analysis and trading is that the analysis is it's done with the benefit of comfort and without stress. And sometimes I see these promotional videos from places that I get in my emails, and you guys probably see them all as well. And a lot of the ideas are great. I just wonder why people can't implement them in real time, or why can someone trade great in a demo environment and not in a live environment. And because that is a very difficult transition for most people to make, what I have realized is I think it's just best to create scenarios where the decision making is kept to a minimum in the live environment. And my issue with some of the stuff I see in the educational space or things that my clients are asking me is a lot of it is so complicated or nuanced that I just wonder, how could someone possibly make a good decision in that using that system or strategy while they have something that they value at risk. And most people, I just think, struggle with that. So everything I'm trying to do is to simplify things, to show these little bits of these different types of analysis that I think are useful, and to let my clients use the files that we create here today for their own benefit. So you can take the software. If anybody here has got a demo or a live account, all you have to do is email your representative in our office. We will send you the chart files, at the very latest tomorrow by the early tomorrow morning. You can tear them apart, work backwards off of it, watch the recording in conjunction with the software. It's a really great way to learn Sierra, and it's a great way to pare down or add to the stuff that we do here. Okay, so that's the general idea, is to show you the power of Sierra, try to help you scale things back a little bit, show you how you can use this program and lever this program to clean things up as much as possible. All right, so that being said, I'm going to throw the charts up first, and there's a lot of stuff on here. I don't want anyone to panic or think I've betrayed you by making the charts look complicated, but I'm going to go through each of these these studies here briefly, and we're going to talk about what's on them and then how they can be cleaned up in a way where people can use them to their liking. Okay, and I'm going to talk about each one of these things bit by bit. So we're going to go through every study that's on here, and then we're going to go through some ways to do some fun things that actually involve instruction in the charting. Okay, so there are 6 charts up here. There's the S&P, the NASDAQ, the Dow, and then the Russell, crude, and the gold, okay, on the bottom. So these are identical setups on each one of these things. It's not a perfect display because some of these products have characteristics that don't match other products, and the indicators need to be adjusted to account for that. I'll show you how. But this is just a way to cram everything on one screen. But what I'd actually like to do is focus on like one product for now, and then let's look at the Russell first, and then I'm going to talk about in a little bit why I'm looking at the Russell. I just want to let me change the time frame on this real quick here. Bear with me. I want to make this the full 24-hour session. Give me 1 minute here to make this adjustment. Oh, you know what? I know what's happening. These are linked together. Okay. All right. So what I'm going to do here is I want to go through each one of the studies that's on the chart, and then please ask questions. This is going to be a great event to ask questions. You're not going to get to ask questions till next year. Okay. So ask away, and anything related to mechanics or the reasoning, I want to make sure we cover all this stuff today. Okay. All right, there we go. Good. Okay, so first thing I'm going to do, these charts are identical, except the chart on the right has a couple of added studies that are generating some lines down here and some colors up here. We're going to get to that in a little bit. But before we do, let's talk about 2 things. First, why we're using the Russell as an example, and then secondly, going through some of these studies and what they are. The reason why I have been talking a lot about the Russell lately is because the Russell is a smaller contract value than a lot of the other markets. So if you look at the current price of the Russell, which is 1390.4, okay, let's just say 1390. Okay, 1390. Every point in the Russell is worth $50. Take 1390 times 50. That's $69,500. That's the current full contract value of the Russell. Okay. Take the current value of, let's say, the Dow. Okay, 23,695. 23,695 times $5 a tick. 23,600. Can I use my calculator? 23,695 times 5 is $118,475. Okay, the S&P 2555, as everyone knows, $50 a point, right? That's $127,000. The NASDAQ, even after the beating it's taken, 6488 times $20 a point, $129,000. Okay, again, the Russell, 1390 times $50 a point, 69,500. All right, the contract is worth a lot less money. That, in and of itself, should be enough reason for someone who is not familiar with the Russell but still kind of scared of the volatility to look at the Russell a little bit. Today it was down 1.75%. The NASDAQ was down 1.82%. The Dow is down 1.58%. The S&P down 1.7%. Very much in line with the other indexes today. Not always the case. Sometimes the Russell is the leader. Sometimes it's the laggard. Sometimes you have news about companies that have a lot of exposure to China, like in the Dow, that are getting killed, and the Russell's not getting killed. All right, the Russell also has a lot of regional bank stocks, so sometimes the financials get hit, regional banks get hit, the Russell goes down worse than the other markets. Just accept the fact that you're going to be trading an index that from time to time is going to be the leader, the laggard, or in the middle somewhere. It's going to be the case no matter what anyway. So once you get past that idea, think about the fact that you can use a wider stop percentage-wise in the Russell than any other market and not necessarily risk more money. So in a day where the Russell's not the complete outlier by like 2 or 3%, let's say, you can usually use a wider stop in this contract and still not risk as much money as if you were putting a wide stop, say, in the NASDAQ or the Dow. So the reason I recommend, for those of you who are struggling with the idea of participating in this market, my advice to you would be scale back the frequency with which you get into the market and use a stop that is 2 or 3 or 4 times as wide as you would normally use, provided that does not exceed your personal daily risk limit. If you are going to risk $4 or $5 or $6 or $700 in a day, do it on 1 or 2 trades in this type of market. Don't do it on 20 or 30 trades. You're going to fry your brain. All right, you're going to pay a lot of commissions. You're going to lose the money in the account. We're going to lose you as a client. Nobody wins. Very frustrating for everybody. All right, so in this environment, scale back the position size, widen the stop out, and just be okay with taking a lot less trades per day. Sometimes it feels like you're not doing anything because of that, but that's not the case. You can still be productive and not be clicking the mouse the entire day. All right, so just something to think about. But that's the reason I do a lot of demonstration on the Russell futures, is because right now it's especially valuable to me, because if I can get more clients and clients of Infinity looking at this contract and they listen to what I'm saying in terms of the frequency of the trades, I believe that I can extend the life of my clients' accounts. That is my personal belief. All right, so that's the reason why we're using the Russell as an example. All right, now let's go through the studies on the chart briefly, and we'll talk a little bit about why we have them displayed this way and what the ideas are. All right, so there's a lot of studies on the chart. If you right click and go to studies on this chart, you're going to see there's like lots and lots of studies here. A lot of this data could be pared back. There are some things you could probably sort of minimize or do away with, but let's go through each one of these briefly. And then if anybody has questions about each one, feel free to ask. And then again, if we're moving fast, which I know we will be, and you want a copy of the file, you can have it. All right, just send an email to me or your rep in our office. We'll get it to you. All right, the first thing, which is kind of like the anchor of the chart, is the VWAP. So that's this black dotted line right here. All right, the VWAP is, in a normal market, this usually acts as a sort of, baseline for the day. All right, this is not a normal market. So the market is often very far away from the VWAP. The VWAP is less valuable right now, I think, as a result of the volatility we're seeing. It's not always going to be this way, but that's sort of like the anchor of the chart, the volume weighted average price. Think of it kind of like a mean price for the day. All right, a volume weighted average price, commonly referred to as the VWAP. All right, there are some overnight high and current daily high, open, high, low, close, and then the previous open, high, low, close data points on here. Okay, that's just related. Those are just levels that I think are relatively important. Okay, the current high, open, high, low, close, and daily open, high, low, close. In fact, I'm really only displaying the high and the low, not necessarily the open or the close. Okay, we have a study here that is called the study subgraphs difference. Study subgraphs difference. And what's happened is, with a lot of these studies, so that I can look quickly and know what I'm looking at, I've renamed them with my own names. So the way to do that, if you have a study on the chart and you do want to rename it, this is particularly useful if you have a lot of the same study with different parameters on the chart. So if you go to settings, you'll see under settings and inputs, there's this short name option right here. Okay, I just typed in today's range. All right, what this is basically doing is subtracting the high and the low using a study called the study subgraphs difference. So it's looking at the current day's high, and then it's looking at the current day's low, and it's yielding a value. And that value represents the day's range. So the reason why we are doing that is because that is incorporated into what are shown here as these MPD lines. We're going to talk about those next. And MPD lines are that stands for maximum permissible deviation. This is a thing I picked up from Rocky Horner at Simpler Trading, and I don't know where she got it, but I think that it's a really interesting idea, because what it does is it creates bands that basically take the range of the day divided by 2 and then add to the VWAP. So whatever the VWAP is, this upper band right here, okay, that is the VWAP plus half of the day's range. And then this lower band down here, okay, that's the VWAP minus half the day's range. The reason why this is particularly interesting to me right now is because it allows you to create bands that are based really only on today's data. So it's very, very relevant. It's not like a moving average that's looking at the last 20 days or the last 50 days or whatever. This is data that takes into account right now the kind of volatility that we're seeing in the market. And the idea with the excuse me, with these bands is the way that I have been approaching them is I like to think that they can be used as entry or exit signals, particularly entry signals for counter trend trades that kind of match up with my personality. And that's where I think that my customers could benefit. So what we've basically done is we've created these bands that are based heavily on the range of the day. So in a market that has a really low range, these bands are going to be a lot tighter together. In a market that has a really big range, they're going to be a lot more narrow. I would be willing to bet you that if you looked at this kind of day, like what we had today, and you put all your other indicators on the chart, okay, not everything, but, and I don't mean I would literally bet you, but I'd be willing to wager, hypothetically speaking, that a lot of people's indicators are just getting destroyed in this kind of a market. They're just getting ripped through, this line crossing that line, blah, blah, blah. They're all getting destroyed. Moving averages are all getting ripped through. The dots, the things you have coming up, they're not working. That's just because in this kind of a market, it doesn't matter. None of that matters. Okay, this is pure panic. It's people getting scared. It's margin calls. It's blah, 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 all the stuff you see that's creating this excessive volatility. If you're going to trade in this market, it's my belief you need to wait until things get tired before you think about entering the market, especially if you like to take these shorter term counter trend trades. So one good way, in my opinion, to do that is to wait for the market to reach an area that sort of statistically speaking is unlikely, with the hope that the idea is that by the time it gets there, it's kind of beat up already. And I have seen numerous times in various indexes, I've also seen it in crude oil, and I've seen it in gold and some other markets as well, where you will see the markets touch these bands. And in certain circumstances, you do get this kind of rebounding like you see on the Russell chart here. Okay? It doesn't hit that often. These don't hit that often. So there's not that many trades, which jives with what I said earlier about trying to pare back the number of trades. You're sitting around a lot. Okay? So with the MPD, the idea is that by the time the market gets there, more than likely, it's probably a little exhausted. That may not always be the case, but I think that frequently enough it is the case. So we'll talk about some other aspects of the chart here, but that's the core of the chart is the VWAP, the upper band, and the lower band. All right. Then what I did was I actually added another set of lines. So there's a study that's hidden right now that is showing half the day's range. We don't need to see it because it's just being added in the background to the VWAP. I also did one that's a quarter of the day's range, and that's what's creating these kind of like middle lines. So here's half of the MPD right here, and here's half of the MPD on the downside right here. Okay, so an aggressive trader might only wait for that line to get touched. Okay, so see how the market is touching the upper half of the MPD, the halfway point right up here a few times. It's doing the same thing here. You're seeing these bounces because what happens is by the time the market gets up here, especially if it gets up there relatively violently, it's usually a flurry of activity that tends to abate. It tends to abate, and that's what we're looking for. So a customer who is a little bit more tolerance for risk, is okay with counter trend trading, and maybe has a little bit deeper pockets in terms of they can sustain or they can add to their position if they want to, might be looking at these bands first. Okay, that's up here and down here. All right. Now, in a market like this, even if you were to get long here and you wanted to use a stop that takes you below the lower band, that is a pretty wide stop. All right. It's a little bit wide even for my taste. And that is like if you were to try to get long as the market is rebounding here and you want to put a stop in, your stop's got to be relatively far. That's a $705 risk right there, even on one lot of the Russell. That just goes to show you how volatile this market is, right? So even risking from here to here is a $705 risk. That's a tough amount of risk for most people to take on one trade. So that's why I'm suggesting that if you're going to participate, you really got to be patient enough for the market to, really feel like it's petered out before you think about, getting into something. Conversely, I know this is super late in the day here. I don't know how many people are taking new trades at 2:50 in the afternoon, but this is not a bad hypothetical example. I mean, the market comes down, rips through that MPD, and then what you're looking for is the market to come back. If you want to be aggressive, you can look for the trade right as it crosses. If you want to be a little bit more conservative, what you do is you wait for the market to start to rebound and you wait for an oscillator like a CCI, which is what I like to use, to start turning up before you look for the long. So in other words, you're using the upward momentum of the oscillator in combination with maybe a green bar or two before you get into a long position. So you're missing out on some potential gain, but you're also waiting for a little bit of confirmation as well. And from here to here, down, let's say this is to me a more acceptable amount of risk. Okay, so if you were to risk the market from, say, somewhere inside this candle to well below the MPD, like maybe down here, that's a $445 risk in a super volatile market. That's not too bad. Okay, so that's an example of how someone might use the MPD. All right. Okay, let's go back to the list of studies. Now the good news is, because a lot of these studies are being calculated in the background, this long list that looks terrifying, we're already through this far. Okay, so we've already gotten through, all these. Okay, this is the CCI, it's down here. All right, that's the oscillator that a lot of times we're looking at. I have a marker for the first 30-minute high and the first 30-minute low. Okay, I don't have them extended off into the future to avoid clutter, but they are there. So if you're looking for a baseline for the first 30 minutes, a lot of people do that. That's an easy one to put up. The other thing we've got are volume value area lines. So this is directly incorporated as well through and some other things we'll talk about here in a bit, but you got the value area low and then the value area high. So 70% of the day's activity is taking place between this range. Okay, that's the value area. So that's what the volume value area lines are doing. We've got the overnight range. So the reason why I put this on here is because a lot of people who trade profile or trade with volume profile or TPO profile will often look for the overnight high and low simply as a level to keep an eye on. Sometimes there's a flurry of activity around these areas. They could be used as a baseline between two very far apart levels if you're looking for a place to get into the market. So you got ONH, that's the overnight high. The overnight low is somewhere else. I can't see it right now, but it's on there somewhere. And then you've got this study called the automatic trend lines. This is something that you really could remove. I like the automatic trend lines. Mine reset every 5 bars. It saves some time, if you do like to draw lines. I don't actually draw a lot of lines, but a lot of times I like to use the automatic trend lines for nothing else to keep me sharp as to how easily they can be broken. And I know that sounds counterintuitive and maybe a little stupid, but the automatic trend lines is a cool thing for those of you who like to draw lines, because they are accurate and it does save some time, and you can choose how often they reset. But they're trend lines and they will get ripped right through. And sometimes it's fascinating to see the market like up here through the upper trend line, and this thing hasn't reset yet, and it just shows you how invalid the line is. But I do keep it up there, even for posterity. And then you've got the volume profile. So there's a weekly profile back here, and there's a daily profile here. They're the same because it's Monday today, so the weekly and the daily are going to be the same. And then I've got my, my value area breach stuff. So the value area breach is basically a combination of the CCI making an extreme level, like below 200 or above 200, or excuse me, below negative 200 or above negative 200 in the same instant or the same bar that the market breaches through the value area high or the value area low. So this is something I'll show you in a couple minutes on one of the other screens. There's none of them visible here, but it's basically another counter trend signal that could be used in conjunction with these MPD lines as well. We'll come back to that. There's another instance of the automatic trend lines on the CCI. This is because I use the CCI to look for a rebound in momentum. Okay, sometimes I'll put these trend lines on the CCI, but they kind of look goofy here, and I could see someone wanting to remove those as well. We'll talk about the overlays in a second. They're not visible on this screen really. They're on the main screen. We also same with the tick. I'll explain that as well. And then we've got a couple of other little bits here. One of them is for the order flow folks. I did add a study that puts a little blue dot. You can see it barely right here on the left-hand side of the screen when the ask volume is greater than 3 times the bid volume in a bar. I have not found this to be particularly useful personally. Sometimes people will use these sorts of order flow custom studies. This is just something anybody can make. It's not something you have to buy. But it's very easy to tell the chart to notify you when a certain threshold is being reached in terms of order flow. All right, so if you want to use it as a confirming thing, like, hey, the market's looking higher and the ask is starting to get pounded versus the bid, and you'd like to be notified when that happens, that's something you could easily create. Any permutation of this study could easily be done. All right, the converse I also have when the bid volume is greater than 3 times the ask volume. Okay, we're going to see a little magenta dot. There's none visible here, so we'll see if we can find an example. The numbers bars calculated values is a study that shows in a table format information about the bar, particularly some order flow things. I only use it because there's a point of control option. And one of the things that I've created on this chart also shows when the point of control is within the highest 2 ticks of a candle or in the lowest 2 ticks of a candle, because a lot of times you'll see like the market come down. Let's say, imagine this like in your mind's eye. So you see a candlestick dropping, and at the very bottom, there's a huge amount of buying to the point where there's so much buying that the price at the bottom is the price that has been traded the most in the bar. And then the market runs up, and then for the next few candles, it runs up. So that's what the low POC is designed to do. So that's what's getting us this little blue star, and this magenta star is a high POC. So the idea with the POC, point of control means most contracts done in a fixed period of time or in a fixed bar type. In this case, we're looking at it on a 5-minute time frame. So what we're basically looking for is to be notified when there's a huge amount of volume at the upper end or the lower end of a bar, because a lot of times you'll see a reversal happen as a result of that. So, or after that, it doesn't necessarily. It's not something you would necessarily stand on its own 2 feet as your sole source of decision making. But if you are a counter trend trader and you like the idea of seeing that happen in real time, Sierra can let you do that. Okay. David, what time do you start the VWAP? I start the VWAP at the previous day's close. Okay, so the previous day's close, I start the VWAP. Excuse me, no, the session opened at 1700 or 5 p.m. Central Time. Okay, all right, so yeah, no problem at all. All right, so let's go to the summary here real quick, because I want to talk about a couple other things. I'm going to maximize the Russell again here, so we can show some other points that I wanted to make. Okay, one thing is you'll notice at the bottom there are some squiggly lines. Okay, so down here I've basically got the yen, I've got bonds, and I've got crude. All right, and this is not something I would always have visible. I do think that crude oil is going to come back into play if it starts breaking any lower than it already is. If you're a counter trend type trader, then you may seriously want to consider looking at crude oil again, because if there is a good long signal, by all indications, the chart is meeting the criteria, but crude oil is making a new low on the day, that might just steamroll your long. So the reason I put crude oil back up here is because it's going to get to the point where if crude starts to fall much further, any potential long signal I think is really going to just get rolled over by crude oil taking the stock market down. So I did add crude here because if I see the potential for a good long, but I see crude making a new low, that would be a good reason to give it some more room or not take it at all. All right, so this is what I meant by intermarket analysis. The magenta line is the yen. Okay, the yen is historically known as a flight to quality instrument, and if you are long the market and you see the yen make a new low on the day, or if the yen is, or excuse me, a new high on the day, and it is really rallying hard, that is a situation where you may want to consider flattening your position. Or if you have a good short signal
and you see the yen making a new high in the day and things are lining up, and that's kind of like the icing on the cake, that is a confirming indicator to be short. So the yen, usually, not all the time, sometimes this relationship gets disjointed, but the yen and the stock market historically have, you know, a bit of an inverse relationship. And then I did put bonds on there, although bonds can be, you know, sometimes ironically the biggest wild card of them all. They don't necessarily move inversely with the stock market anymore because of the interest rate conversation. But a day like today, where the Dow's down 360 points at the close, you'd think bonds would be up more than, you know, half a handle, and they're not. So bonds are probably the least useful right now of the three, and you know, you could probably safely remove that. The other thing that I added here on the same level as the CCI, and I only added this on the same region as the CCI because to save space. I didn't do this to like interact with the CCI at all. When I look at this, I don't even see it that way. You could put it anywhere. You could even just put the value up here somewhere if you don't even want to see the line. But there's a lot of people who still, you know, ask us about, you know, tick fade style trades. And since we're talking about counter trend trading, I think that it's worthwhile to at least explore the idea of incorporating the tick. So what that's basically saying is that if you see the market falling here and you see a potential for a long position about to happen, and you see the tick go severely, severely negative, that is usually not sustained for that long. The same way that the CCI ripping below like negative 200 is usually not sustained for that long. So if the market is going lower and you see a potential buy starting to counter trend buy starting to form up, some of the things you might be looking for, besides the market starting to turn back up and the CCI, you know, starting to turn back up if you're patient, is what is the tick doing? Okay, if the tick is hovering at, you know, negative 300, negative 500, negative 600, it's not doing that much. That just might mean, you know, orderly, sustained selling, and that might be a reason to not get long, because that just may continue. But if you see the tick spike lower, like negative 800, negative 1,000, negative 1,100, then that is usually a level that is not sustained for very long. And a lot of times what you'll see is a response, like a buying response to the market saying, okay, this is an excessive amount of selling. Now there's value, and all the computers and whatnot start, you know, reversing the direction of the market. And then, you know, you get this pop like you did into the close today. So, you know, there's a lot to look at, you know, on this screen. You know, sometimes I feel like I've overcomplicated things a little bit, but what I can definitely do is this can definitely be pared back to significantly. So what I would like to do is demonstrate a couple of those, you know, a little bit of that, and then, you know, we'll take a bunch of questions and so on. Mark says negative 1,200 equals a buy. Yeah. So what Mark's saying is that if you see the tick hit like a negative 1,200 level, and you are comfortable being long a market that has just fallen a bunch, because it will have had to have fallen a bunch in order to generate a level like that, then a lot of times you will see the market rebound. It's just a matter of being able to, you know, take enough heat to catch it. And going back to what I said earlier, that has a lot to do with, you know, your discipline with respect to how quickly you enter the market with what quantity, and also what contract you're trading. You know, so that's agreed. Okay, so what I'm going to do now is let's look at a different market. Let's look at the S&P for a second. All right, so what I'm going to do now is I'm going to make the S&P chart bigger, and then let's duplicate it, and then we're gonna clean up the duplicate a little bit in terms of, you know, just kind of like reducing some of the data to what might only be necessary. And then I would like to take, you know, some questions. There's already some coming up. And Howard, yeah, thanks for your comment there. Howard says, I think this is a great chart to learn from. Yeah, I agree. And I think that the reason why it's important is because it's largely range-based. So the core of the chart is range-based. And in a market like this, you just got to throw some things out the window and just look at something that will give you zones that are based on range. I think that's a really important part of surviving this current situation. Okay, so thanks for saying that. Okay, so One thing that I want to show that we didn't see on the other screen was this blue value area breach thing I was telling you about. Okay, so with this, look what's happening in this bar. So here, the market is going lower. It is hitting and breaching the value area low. That's this red dotted line. So the red dotted line is value area low. This is where it was at the time, right here. So the market is going through the value area low, which means it is now breaching out of the range where 70% of the volume in the session so far, starting last night at 5 p.m. Central, has traded. So this is right after the open. The market decides it's going to break lower. It comes through the value area low. At the same candle, the CCI goes below negative 200. That's what generates this blue signal. So the value area breach idea is basically saying that the market is breaking out of a well-established range, and that range has been established since 5 p.m. last night. It's now 8:40 in the morning. Now, granted, there's a lot of volatility in the first 10 minutes of the New York stock market session, but the market is breaking out of that range, and in the same time, the CCI is reaching a level that is not commonly reached. Okay, the CCI does not go below negative 200 that often. Look through the whole course of the day. It only did it maybe twice. Here it came close, but here's one and here's one. It didn't even get above 200 at all throughout the day, right? You can see that. Didn't even get up here at all. So it just doesn't happen that much, and it's not usually sustained for very long. In addition, the market is hitting the halfway point of the MPD, of the 0.5 MPD, rather, the halfway point. So a relatively aggressive trader might say, okay, this value area is being breached to the downside. The CCI is breaking through a level that it doesn't sustain very long, and the market is halfway to its maximum permissible deviation. A gutsy trader might look at a long position there. Now, in a normal market, you're thinking, okay, like I could put my entry here, and then I could put my stop underneath the MPD. But look here, the problem with that is that in this market, that's a $1,300 risk. So that is not a viable situation for most people. Now, the good news is that in order for you to risk this much, you're actually risking, all the way down to 25.40 something when you're getting into the market around 25.60. You're probably not going to use that long of a stop anyway. So I highly doubt most people would let it run, that far. But the idea is that as you approach this idea in other markets, or maybe even Russell or any other smaller markets that you might be trading, you want to give this thing some room. And a lot of times what you're going to see is, even if you take some heat on it, a lot of times the market will at some point turn before it gets you. And the problem I think that most people have is they don't have the patience to just stick with the trade long enough. They'd rather keep clicking instead of just putting the stop in and giving it a chance to breathe, wash everybody else out who's trading with the 6-tick stop, and then go the other way. So this is a good example of a short-term, entry that I think is a reasonable entry. You got a few things happening at the same time, right? You've got the value area being breached, the downside, you got that CCI. CCI starts to turn up a little bit. You've got the market hitting this 0.5 MPD, which is not perfect. We'd rather it be down here, but take what you can get. So that's a reasonable idea in my opinion. Okay. If you wanted to clean the chart up a little bit, I would say that the things that could probably come off, if necessary, you could definitely take the profiles off. I'll take off the weekly and the daily. The automatic trend lines could come off. Take them off here as well. These little order flow tools, this is not true. This does not happen that much in the S&P. The order flow being, that far off to the point where it's 3 times the other direction. So, you know what? In fact, in order for me to do this without messing up the other charts, I would actually have to remove this link here, because these are all linked by study. So if I make the change to one, it's going to make them to all. So let's make sure we remove that link first. Okay. Oops. So now we could do this without worrying about messing up some of the other charts. So again, just to try to, to clean things up a little bit, let's take off some of the lines. So I'll take the trend lines off, take the profile off. Here we go. Okay. Probably take bonds off. Okay, so now we've cleaned it up a little bit. So you've got the tick, you've got the CCI, you've got a couple of related markets, and then this chart to me is not overbearing. You got the previous day's low, the overnight low, value area high. This is the midpoint of the session, so the exact halfway point between the high and the low. You've got your MPD, your 0.5 MPD. This is today's low down here. Okay, overnight high is up here. There's the previous day's high. So does this chart look, that complicated to the point where anybody here, feels like they couldn't make sense of it? I think that based on the feedback I generally get from my customers and the screenshots that I get sent and such, I feel like there's enough here that could be made use of without overcomplicating things. All right, there's a couple of starry and dotty looking things, right? These are the power, the point of control things we were talking about. Like, so here's an example of, this is not a great example, but let's look at these two. So this one here, this is a good example of one of those sort of rejection style candles. Now this did not work here, and this would actually have been a viable signal because it's 7 in the morning. This is something I may not have ignored to my own peril, but here's the market coming lower. There's not that much going on. It's not that much going on. Then down here, just a flurry of buying. So buy. The bar closes. Turns out that the point of control of this bar is somewhere in these bottom two ticks. So that's what generates the blue star. All right, that's what generates the blue star. All right, and then you're seeing that value area breach as well. And then here's one on the other side. So this is this is one that obviously we have the benefit of hindsight. I don't think this would have been a valid short because there's really nothing else to prove that. But you have the market coming up right here, and then up here you've got a large amount of selling relative to the rest of the bar. So by the time the bar closes, the market is the point of control ends up in these top two ticks. Okay, so that's a sign that you had a whole bunch of selling happening way up here. So that's something you probably you have to be there. You have to be watching it when that happens. Okay, so we could alert you. You could get an email to your phone, or you could get a sound alert or something like that. These are just showing the stars, but you could easily be notified when something like that happens. All right. So Stu says, how do you automate all of this? I've thought about that, and you definitely could. I believe that you could automate those extreme areas, like the MPD areas. Sierra is not that complicated to create an alert that would alert you when all these things are sort of happening at the same time. The problem is, I think that a lot of this is actually very intuitive, Stu, and I think that every situation is like a little bit different. So, for example, if you were looking for that MPD at the very bottom, on the chart down here, how many of these are you going to miss because you made it so that the automated system says that the tick has to be greater than less than negative 800, but it only got to 795. That's the kind of situation where I'm not sure you could I know you couldn't perfectly do it, but I imagine that something like this that has a few different things to consider, you'd have to create quite a complex algorithm to take that trade for you in an automated fashion. I'm not saying it couldn't be done, and certainly you could make it really simple and just say, look, if the market hits the MPD and it hasn't hit it in the prior 5 bars or something, go long. That's easy to do. Okay, you just make it so that the code basically says, if the high of the bar or the open of the bar is above the line and the low of the bar is below the line, go long. That's something that could easily be done. So if it were something as simple as that, sure, why not? All right, but I think incorporating things like what's crude oil doing, what's the tick doing, what's the yen doing, is the CCI turned up or down, or how steep is the line? These are things that I think would be a little bit harder to automate. I think at its core with the MPD, you could probably automate that easily, but there might be situations where you're in a trade that you shouldn't have been in, and vice versa, even if you were sort of following the rules. Okay. A couple other things that I wanted to show. So let me get rid of this chart here for a second, and I'm going to remove some of these overlays that are really non-functional because these markets are not present in this chart book. So I'm just going to clean them up real quick. Okay, so one question that I started getting was, okay, Patrick, how can I filter out like really obvious, bad, potential bad, counter trend trades? Okay, so there's no perfect way to answer that, but one thing that we did incorporate at the request of a few people who are, quizzing me a little bit about this was if you also would like to make sure that you're not getting long, in a downtrend that exceeds like your threshold, and you would have to define this. One thing you can do in Sierra is you could create studies that look at the angle of lines. So in this example, we've done this a few times over the last couple of years with webinars. Like in this case, I added an 8 and a 34 period moving average, and then I added a study called study angle that measures the angle of both of them. So the 8 and the 34 period is this magenta line, that's the 34, and this 8 period is this blue line here. We can actually hide those. We don't even really need them visible. But the idea here, and in fact, let's do that. So let's hide the lines. So we don't even need them up there. And we actually even don't even need the angles, but I'll show them for a second and then I'll hide them. But what these lines are doing is measuring the angle going 10 bars back of each of the moving averages. So that's this study and this study here called study angle. So this one's measuring the angle of the 8. This is measuring the angle of the 34 with a starting point 10 bars back. So let's hide those for a second. Okay, we'll hide them. We don't need them visible. Okay, there they go. And then what this study is doing, this is the color background based on alert conditions study. And what it is doing is it's measuring when the angle of both of the lines are above 0 and both positively sloped. So what's happening is the green is coming up. The green is happening when both the moving averages have positive angles, so greater than 0, and they are both upward sloping, meaning the angle currently is greater than the angle in the prior bar of the same study. So I used 8 and 34 because those are just my defaults on the study, but you could use longer lines if you wanted to look back a little bit further. But the idea here is that there are ways also for Sierra to try to help you keep out of stuff. So one thing I'd like everybody to think about is a scenario where certain series of conditions exist that really make it bad for your trading style. And don't only use Sierra to find the positive stuff. Use Sierra to filter out the bad conditions as well. Okay, let's do like one really quick example of it. This is very, very oversimplified, but here's an example of that. So let's bring up, let's say, the NASDAQ. Okay, that's a 5-minute chart. I'm going to add the ADX to the chart, okay? So ADX. Okay, so there it is down there. Let's make it a little bit easier to see. So here's the ADX, like that. Okay, so it's at 27. So sometimes people will say, Patrick, I only trade when the ADX is above blah. All right, some of you may have heard this as well. So what you could actually do in Sierra is you could use that color background study, okay, and you could put in a little code that will tell you when that is or is not the case. So as an example, let's say that I only want to be able to, my system says that I'm only putting trades on when the ADX is above 30. Okay, so you can actually add the color background study and then look at the ID number of the ADX. See how it says ID1? And And then if you go to the subgraphs tab, see how it says SG1 right there? So the way that we're going to refer to the ADX is ID, either :1 or .1, it doesn't matter. But ID1, or excuse me, ID1, you could use the colon or you don't have to, but ID1.SG1. So the study ID number and then the subgraph number. All right, the nice part about the ADX is that it only has one subgraph, so there's not like a long list of subgraphs we have to remember what they are. But the way that you would refer to this in the color background study, and this is why I say Sierra is great for people who are not professional coders, because like, for example, like me, no development experience whatsoever, but I can create these, kind of cool alerts based on criteria that I can explain in English. So, all right, I want to have a background color like this. Let's lighten it up a little bit. Okay, when the ADX is, less than 30. Okay, so I just do ID1.SG1, which is how we refer to the study, less than 30, and push apply. So what you basically have is, a no trade zone. Now, again, this is an oversimplification. It's kind of silly, but this is an opportunity for everybody to start thinking not just about what the signal is, but what are the scenarios that you're used to dealing with that result in you getting chopped up, or where with the benefit of hindsight you go back and look and say, oh my God, it was so obvious because this, and this were happening. Well, jot down what those things are, and we can help you, and we can probably help you create something that will display, a certain condition or a certain result when those conditions are true. It's a really cool feature of this program. It's something I use every single day. And the beauty of it is you don't have to be a developer to do it. So if you have an idea like, okay, when this, and this are true, tell me so. Either for, the objective of staying in a trade or getting out of a trade or not getting into a trade, or something very easy or general like this. A couple of groups that we work with that use profile in their trading, volume profile, they will have the background colored of the chart if, the market is above its value area high or the market is below its value area low, and that defines whether they take long or short trades, just flat out. And so what's kind of cool about this idea is that you can sort of shift the responsibility off of yourself and put it on the chart. Makes it a lot easier to follow the rules. It's kind of like, it's the closest you're going to get, I think, to having like a risk manager, as if you were working at a proprietary trading firm, standing behind you, enforcing, via a slap to the back of the head, his rules or her rules, right? So, using the program in this way allows you to shift the responsibility a little bit off yourself and onto the program. It's a really cool idea that very few people, I think, really run with, but more people should. All right. Okay, a couple questions. So David says, off topic, can you answer at the end, do studies affect each other, or is it important based on how they are positioned in the studies to graph list? So yes, namely the color background study that's where this becomes important a lot, because it could have to, if you have situations where two color backgrounds, for example, are on and they're both true in the same bar, how can it display them both, right? So it won't be able to. So that's why sometimes I use combinations of the color bar based on alert condition, which gives me these sorts of notifications, and the color background, which gives me like the background color. But if you put one above the other, you might see, it gives it an order of precedence. I don't know exactly what the rule is. It's actually somewhere on Sierra's website where they actually define this. But there is like a precedence rule. I haven't really seen the order of what I've got up here affect any of my calculations in any way. It's mostly what is displayed first, that sort of thing. Yeah, you're welcome, Gary. Okay, Elaine says, is it possible to visualize some numbers based on studies to appear when you move the crosshair over the bar? Yeah, so if you have the crosshair on, okay, like this, there's an option here under a lane that's called Tool Values Window. And the Tool Values window is not like the quote window, like what's called the compact Tool Values window. That's this little guy right here that just shows like open, high, low, close. Okay, that's this thing. So I'm going to disable that and it's going to go away. But this other one here, it's called the Tool Values window. And you'll notice that it's wherever my cursor is, it's adjusting the values of all of my studies. Now this thing is a long, long list because there's tons of studies on here, right? So it's moving, with my mouse. So as I move the mouse around, I can see those values moving around. Okay, so that's called the Tool Values window. It's under Window, Tool Values window, and you just have to make sure, if you're going to use that, you have to have the crosshair on. Okay? Yeah, definitely. Okay, cool. Let's see. There were a couple of questions that came through earlier about some more of these color background examples. I did have, this is the same or a similar chart on crude oil, but I'm going to get rid of this chart book because the overlays are not working in some of these other files. So I'm really going to focus on these here. There were a couple other questions that came through. Let me scroll up here just a minute. Oh, margins, yeah. Okay, so for those of you who are not familiar with Infinity, so it's a $3,000 account minimum to open the account. The day margins, we go as low as about $500 a contract. Okay, that's very aggressive. We ask that people use day margin gingerly. Okay, especially in this kind of market, it's really hard to justify trading one contract per $500. But we also, as a futures only firm, we have great risk technology, and we don't feel the need to increase the margin requirements every time we get a little spike in volatility. Okay, so that has not been our MO, really ever, at least since I've been here. I've never seen a situation where we've had to increase, on Infinity AT, we've had to increase our day trade margin rates. All right, that's just not something that that we've had to do even under these sort of stressful environments. So if you're with a firm that tends to treat futures more like a side project where it's not their focus, you're generally going to find that they are a little bit more risk averse in what they will do to demonstrate that is they will eliminate or raise the margins on day trades, sometimes without a lot of notice or no notice at all, which can obviously be a pain. So we do have a lot more flexibility, with the day trade margin, right? Okay. Okay, cool. So does anybody else have questions specifically on this idea here? Is there anything that I can clarify about, or do you guys get it? I mean, is it making sense? The idea is to try to eliminate, some of the reliance on indicators, at least for now. Doesn't mean forever, but instead shift the focus onto the ranges and how the market is meeting these extreme ranges. All right, I think that in this type of an environment, it's a better choice for a lot of folks. Okay. Let's see, Lawrence. Patrick, what does Sierra have that shows strong momentum or momentum and volume? Well, Lawrence, that is a really open-ended question, and I know you don't mean to ask it in an open-ended way, but the fact is that Sierra has, you really just have to tell it what to do. I mean, here's an example of that, okay? So how do you define momentum? Well, I mean, you could define momentum as in using an oscillator like momentum. Okay, that's one way. All right, let's put this on the screen just for a second. And again, this is for this, more of for a sake of demonstration. But let's do a quick example of how I could answer Lawrence's question. So how do you show momentum and volume? Well, here's a momentum oscillator. All right, that's one way. All right, let's go to a shorter time frame, like 1 minute. Okay, this is a 1 minute chart. So how do you define momentum? Well, momentum could mean this line is going up. Okay, momentum could mean a certain number of higher closes in a row, right? Volume could mean a lot of things. Volume could mean, just regular old volume is spiking. Okay, so let's create this little idea based on what Lawrence is suggesting. So how could we show strong momentum or strong volume or both? Okay, well, one way would be to just look at the lines. Okay, another way would be to use some of the Sierra's capabilities to tell us when these things are happening together. So as an example, the momentum oscillator has ID1 subgraph number 1. So one way to combine very obvious momentum in the form of the market closing consecutively higher and that momentum line going up would be to let the chart tell us when they're happening together. So here's an example. I could say when let's do this color background example. So what we'll say is this: when the momentum study, which is ID1.SG1, is greater than the same momentum study, ID1.SG1 1 bar ago, that's our first condition. So the momentum study has to be going up. The second condition is going to be the momentum study 1 bar ago has to be greater than the momentum study 2 bars ago. So the momentum study has to have gone up 2 bars in a row. So we're going to encapsulate that condition with the word and push apply. Okay. Excuse me. So this is now telling us when the momentum study has gone up 2 bars in a row. And we could also say, all right, what about when, let's include the volume, which is going to be V. This is going to keep coming up here because we're going into our maintenance period, which means we do have to wrap it up soon. But hang on a sec. We'll keep this going for another few minutes. Okay, so let's say that in addition to the momentum, we also want to see when the current volume is greater than 1.5 times the volume 1 bar ago. So in addition to the momentum going higher, we want to see when the volume is greater than 1.5 times the volume in the prior bar. So when we apply that, a lot of our results go away. And, excuse me again, we may have found a really great counter-trend strategy or an opposite strategy. Look at this. All right, so momentum is rallying. It's gone higher 2 bars in a row. The volume in the current bar is greater than 1.5 times the volume in the prior bar, and it sucked everybody in. Same thing here. Momentum is going higher. The volume in this bar is higher than the bar prior. Sucks all the people in, and it tanks. So the cool thing about this program, Lawrence and everybody, is that if you can define, you have to find a way to define what you're asking. And really the beautiful part about it is that you really just have to speak it. But Sierra has a lot of tools. You just have to be able to tell Sierra how to give you an answer. And you don't have to be a programmer to do it. You have to learn a little bit of really basic stuff on how to refer to these different aspects of the studies, greater than, less than, greater than or equal to, and so on. But this to me is a great example of instantly, hearing what somebody is looking for, putting it on the chart, and putting something up in 2 minutes that really anybody could do this. You just need to be able to understand some of these definitions. And when you look at this, imagine if you had just walked in the webinar and the first thing you see is this thing here. I understand that would be intimidating, but when you saw how we just pieced it together, I know I went fast, but it's really just a few pieces separated by a comma. And you just do it one by one. You just lay out the conditions one by one, put them all together, and stick the word and in front. All right, one giant parentheses, everything inside needs to be true. All right. If you are interested in learning, that type of stuff, there is a really good YouTube playlist we have that shows really basic beginnings of color background conditions. Okay. If anybody wants to learn how to do this, seriously, watch some of these videos. There's a couple of them that are a little longer. You don't have to watch the ones that are 20 minutes long if you don't want to, but there's a few in here that are, 6 or 7 minutes. This is a really great playlist for everybody to watch if you would like the idea of, being able to do this kind of fun stuff in the program. All right. Excuse me. So For overlays, E-mini-mom, for overlays, can I have the reference charts I want to overlay in another chart book? No, they got to be in the same chart book. Okay, they do have to be in the same chart book in order to work. Okay. Yeah. Okay, so Kate says, could you show a spot where the candle has the same 3 color candles in a row? Yeah, like that's another example. So let's just give you a quick example on that. So I'm just going to duplicate this chart. I'm going to clean these studies off here, except for the color background. Okay, and so let's just say that, you know, if you wanted to say, okay, we need 3 consecutive, you know, upward candles. All right, so here's how you define that. You would say, for the first candle that we're in right now, you would say the close is greater than the open. All right, that's our first condition. There's all the times in the current screen that the close is greater than the open. But now we also need to see when the close 1 bar ago was greater than the open 1 bar ago. Okay? And then we want to say, okay, on top of that, the close 2 bars ago was greater than the open 2 bars ago. So now we have 3 conditions: close greater than open, close 1 bar ago greater than the open 1 bar ago, close 2 bars ago greater than the open 2 bars ago. So we put the word and in front, big parentheses. You're now being alerted when you have 3 consecutively higher closes. Or basically 3, not 3 higher closes, but 3 positive candles. You know? So it's really easy stuff. It really is. It looks complicated when you look at it the first time. There's not that many operators. Greater than, less than, O for open, C for close, H for high, L for low, V for volume, BV for bid volume, AV for ask volume. There are, beyond that, there's really just not that much more to it. And think about, like, you could do so much even without indicators. I mean, you could use the structure of the bars themselves to create something like this. It's really fascinating stuff. All right. Okay. All right, folks. Well, I think that is probably where we will wrap this up. I'm going to save all of these files. There's a couple that I deleted that, you know, some of the overlays weren't working and such, but the main ones, I'm going to keep them all. I'm going to title them up, and then let's, you know, I really hope to see some people request some of these things and make use of them, because, you know, I have one vantage point, but I'm really interested in the feedback. And if you feel like something is totally dead wrong, or you can improve upon it and you're willing to share it, believe me, we have a community of people who would be willing to, you know, to listen, and certainly I would be willing to listen. So again, thank you for everything this year. I appreciate it. Stay tuned. Okay, we're going to be, like I said, making some changes to things next year, but it's all good stuff, and it's all about delivering, you know, more content, not less content, and more efficiently. And it's going to be a fun, you know, first part of the year. So thanks everybody for listening and for referring their buddies and their pals. It really means a lot to us. You know, online trading groups and word of mouth, that is really how Infinity grows. We specialize in the support aspect of things, and we're willing to put, you know, a lot more effort than a lot of our counterparts. We know this. Okay, we know it because we hear it from everybody. So please refer your groups to us, and if you want to do some small group training, you got a group of 10 or 15 people, and you'd like us to come in and do a little thing on the charts just for you and your pals, you know, that's something we would love the opportunity to do that as well. All right. The recording will be up on YouTube and in chartingclub.com. Okay. Everybody should register at chartingclub.com. Okay. It's free. There's no account information on here. It's just your first name, last name, and your email address. It's a free registration. This content is getting better. It's getting updated every week. Everybody in our office is contributing these different ideas and getting feedback from people. So we're using this as a place to build a good database of videos. So everyone should register there as well if you haven't already. Okay, that's where the recording will be. It'll also be up on YouTube as well. All right, folks. Well, I appreciate the opportunity. Thank you again. We'll read some risk stuff here one more time and close the room. And all right, everybody, we will see you next year. Thank you so much for coming to the presentation and for listening. Thank you, folks. All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors.
You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations can change at any time. Past performance is not indicative of future results. All right, everybody. Thank you. See you next time.